Afternoon, everyone. Welcome to this afternoon's special webinar on financial assessments. Very pleased that you join us on for the lovely sunny afternoon where you are. If you haven't been along to one of these events before, one of these webinars before, I'm Paul Smith from Foundations. We're here to help and support local authorities and home improvement agencies across England, particularly with anything relating to disabled facilities grants, hence our webinar on financial assessments this afternoon. And if you're interested, we do a free range of quality standard assessments around DFG. We do free DFG training sessions on legislation and regulations. We're doing 2 of those a week at the moment, and they're totally free of charge as well. And if you're interested in looking at your DFG process, we can also do a workshop around that. Interested in any of those, please go to the Foundations website or email us at info@foundations.uk.com. So I said this afternoon we're going to be looking at financial assessments, and particularly the social care financial assessments. So I'll introduce Dan in a minute, who will be talking to us about that. But you may have seen some of the presentations we've done before around the DFG means test in particular. And as you may guess, I'm not a great fan of the existing DFG means test. It's something that's based on housing benefit. And the idea back when it was introduced in late 80s, early 90s was to target grant aid on the most needy households, as they put it back then. It was introduced in 1989 Acts of Parliament, and it was criticised as early as a review they did of it in 1992. Subsequent reviews in 2005, 2011 and 2018 all recommended looking at how social care was assessed as an alternative to the DFG means test. And so that's what we're going to look at in more detail this afternoon. I think some of the issues to bear in mind is it fair to have separate tests for home care and home adaptations for somebody that may need both to live independently at home? And as issues around social care have crept up the political agenda in recent weeks, and the notion of introducing a care cap has been floated again, if we had the same system for both, could that make it easier for adaptations spend to contribute towards a care cap, for instance? Based on if you're spending money towards adaptations, then you're less likely to need as much care in the future. So you're spending less on care, and you're also less likely to ever reach your care cap. So that would save the country money as well. So it could be a win-win for everybody. So we've got Dan Rust here from Turquoise Training this afternoon, who's an expert in Care Act financial assessments, and will be taking us through how they work. So we've got the chat box as usual, so please feel free to chat along, either with comments to us or to each other as we go through. And we've also got a question and answer box. So if you've got particular questions that you would like answering, please pop them in there and I will pose them to Dan either at the end or as we go through the presentation. So I will stop sharing my screen and invite Dan to share his screen and to introduce himself.
Thank you very much. Just give me 1 second and I'll get my screen up there. Okay. Thanks everyone for coming along, for having me. It's nice to be invited to talk about this. What I'm planning on looking at today is going through how the financial assessment means test works. This is I do a 3-day course on this for local authority financial assessors to learn how to do the job, to try and get them up to speed, either if they've never done it before or if they've been doing it for decades. We're going to cover quite a lot of what we cover in that 3 days in an hour and a bit. So it's going to be relatively top level. We're going to call out a lot of the most interesting. I say interesting, hopefully somewhat interesting. We're going to try and bring some insights as to how it works, how that might affect any changes to DFGs. Let me just let you know a little bit about who I am. So I run a training company. We do consultancy and we do training on social care finances, but also on benefits, on universal credit, on council tax, all sorts of different things. Work with a lot of different organisations, So we work with the Guardian newspaper to provide their budget day coverage on what changes mean for benefit claimants. I've worked with the BBC, making sure that the characters in EastEnders get the right benefits based on their personal circumstances. Work with various housing associations, with organisations that are helping people off benefits and into work. And I've worked with many different councils. So the thing that's most relevant here is I've trained dozens of local authority officers in how to perform a financial assessment. We're doing that for about 4 or 5 years. Before that, I worked in housing benefit for around about 10 years. So I've got experience on both sides of this, the means test for housing benefit, the means test for social care. All right, so what's the plan and what we're actually going to look at? So we'll start out by talking about the point of the Care Act. So came in 2012 and then was put into force some for financial assessments. Not 2012. What am I saying? 2015. It's Care Act 2015. I've got my welfare benefits head on there. 2012. It came into effect for financial assessments from 2016. So we'll talk about why they did that. What's the point of it? What is the aim of this assessment? And then we'll go through an overview of the calculation. So you've got an idea where we're going. This is the plan. This is the intention. And then we'll itemize each thing. So we'll go through income. How do we look at income? What do we ignore? What do we take into account? How do we analyze someone's income? We'll do the same for capital. So your savings, your capital. What do we treat as something that's going to have an effect on your finances? And then finally, we'll look at your expenditure. So we've looked at what income you've got, what money you've got coming in. Well, we'll then analyze what of that do you need? What can you keep? What would we expect you to need for your personal circumstances and various other things that we think you need to pay for? So the Care Act, the point of the Care Act really was, there's a lot of things, lots of things to it, but for the financial assessment side of things, why has it been set out the way it has? Well, prior to this legislation, the assessment of what you need to contribute towards your care across England and Wales was guidance rather than legislation. There's a lot of things were set out in such a way that the local authority had a lot of scope for changing it to how they would like it to be. So there's a lot of different things going on in different local authorities, such that you could have very similar circumstances be in neighbouring authorities and have to contribute very different amounts. The Care Act is designed to make that uniform and to make sure that across the country, in every local authority, no one pays more for their care than they can afford. When I do this course in local authorities, I make that a mantra that everyone says at the start. So what are we here to learn? We're here to make sure no one pays more for their care than they can afford. We're going to go into minute detail when we do an assessment to figure out exactly what you can afford and what you can't. We're also, an aim behind the financial assessment is to promote well-being. It's not just making sure that you've got enough money. It's ensuring that you have enough money to have the best, to be able to live the best life that you can. So it's not just making sure you've got the money, it's making sure you've got enough money to do the things that are going to be good for you, not just the bare minimum. We're going to try and make sure you have the best life that you can by keeping enough money to pay for the right things. We're going to analyse just the finances of an individual. So with benefits and with DFGs previously, the assessment is for a couple. So your couple, maybe a household, we're going to look at your circumstances together. With a financial assessment, we're just looking at individuals. So you personally, what is your money? We're not interested in your partners. If your partner's got money coming in, they've got savings, they've got expenses, that doesn't matter. It's what your individual finances are. And then the way it's set up is to try and make sure that money which you have got, which is designed to support your care needs, is going to be used for that. So any excess money you've got, money which we think you don't need once you've covered all your costs, and money which you've been paid deliberately to pay for your care, we're going to take that into account. So again, very different to benefits, very, very different to a housing benefit test, where money that's being paid to you to support your care needs is going to be ignored. In our assessment, we're looking at what money do you have to pay for your care. So we are going to take it into account. So your attendance allowance, your personal independence payment. Conversely, on the other side, we're going to try and encourage certain behaviour by disregarding some of your income. And the most important, one of the most striking one of those is your earnings. So if you're working, then again in benefits, we're going to take your income from your employment or your self-employment into account. But in a financial assessment, we're not. We're going to ignore that. So we want to say to people, if you're disabled or if you have a condition which means you have a care need, then if you can work, we want to encourage that. So we're going to allow you to keep the income from your earnings. So your earnings, various other things, we want to encourage you to be able to get about. So we're not going to take your mobility payments into account. We then disregard those. So in a minute, we're going to go through different types of income and look at what counts and what doesn't. But the general purpose here is to try and make sure that we're encouraging the right behaviour and we're taking the right income into account when we're working out how much money you've got to pay for your care. Okay, so let's have a quick look at. I see various things coming up in the chat. I haven't seen them. I'm not sure, Paul, if you're hopefully you're aware of that. Hopefully there's not an issue on my end.
Yes. Yeah.
Okay. Just wanted to check people could still hear me. Everything was right. I see you flashing up. So the calculation for our assessment is going to follow the same process all the way through. This is going to be true for people in domiciliary care, but also the same process goes for residential care as well, if we were interested in that. First thing to do is to look at what capital you have, total that all up, add up all the capital that you have. We're going to allow you to keep some of it. Certain types of capital you'll be able to keep, and of the rest of your capital, we're going to say you can keep some. The crucial thing we're looking at first is when you're over the capital threshold, we're not going to give you any help. We'll have a look later at what that threshold is. But there's a hard limit. If you have savings and capital over that limit, you get no help from us. If your savings are below that, we can go on to carry on with our assessment. Our next stage will be to total all your income. And then if you do have some savings, we might expect you to contribute some money from those savings. We're going to add all those things together. Again, some of your income we're going to disregard. So we won't be counting all of it. Certain things we think you should be keeping. We'll add everything else up and we'll come up with a total figure. This is your income. We'll then compare that to your expenses. So we've got three different types of expenses. Expenses for personal costs. So the amount you need to meet your food and living costs, pay for your bills, pay for any travel, clothing, things like that, your essential living expenses. We'll give you an allowance for that. We then think that you are very likely to have expenses particularly related to your disability. So this is an extra step on from benefits, where in benefits you might just have an applicable amount, which is similar to this personal allowance. We're going to assume you've got extra costs. If you are someone who needs care, you're likely to have additional costs. So we're going to work out what they are, and we'll let you keep money to pay for those things. We'll go into that in detail in a little bit. And then finally, your housing costs. We know you need to keep a roof over your head, so we are going to give you an allowance equal to whatever your housing costs are. So if you pay rent, whatever your rent is, you get to keep an allowance for that. Your council tax, whatever you pay, you keep an allowance for that. Your mortgage, whatever you pay, you keep an allowance. It's not an average, it's not what's reasonable for you or reasonable for someone in your area, it's your actual costs. What we'll then do is we'll deduct your expenses from your income. So add up all your income, add up all your expenses, take one from the other, and that will give us your excess. So whatever income you have left over, we think is available to pay towards your care costs. And then again, unlike housing benefit or other benefits, we are going to say all of that excess is available to pay for your care, so you can pay that towards your care, the full amount. There's no tapering in financial assessments. They're not saying, well, you can keep a third of it or keep 2/3 of it. No, everything you've got over that expenses threshold, you will have to contribute towards your care. Right, let's have a look at any additional things we need to just have in mind before we dig into the calculation itself. So we said before that this is all about individuals. So we're not looking at you as a couple. We're saying you personally, what's your income, what's your capital, what's your expenditure. One of the key things for that, which local authorities should be keeping in mind, is that any jointly held income and capital, we need to divide appropriately. So if you've got a joint bank account, we'll take it account in our assessment, but we'll probably divide it by 2. We'll just count your half of it. If you've got a joint income, something like pension credit, which is applied for as a couple, again, we'll divide that by 2 and just count half of it. If you've got capital held with multiple parties, then divide it proportionally. And if you happen to have a greater share of some capital asset, so you've got a property and you have ownership of 2/3 of it, we'll work out your 2/3. That's what we'll take into account. So divide it appropriately. I'm just going to point out at this stage. I'm not going to go into this later on as we go through the rest of the calculation, but there are local authorities who will look at you as a couple. The regulations do not require you to do that, and there are no allowances for couples. There are allowances for you if you're half of a couple, but there's no legislation that says this is what you must do if we're looking at a couple. But lots of local authorities do. It's a carryover from the old system, the fairer charging system, where we would be looking at you as a couple as well as an individual. And many councils think it's fair and appropriate that we should look at you as a couple, but it's not required. So we'll go into that in any more detail here. It's not in the rules, not in the regulations.
I think there's a couple of differences between DFG there straight away, Dan, that in DFG you are taken as a couple. So kind of Care Act assessment would seem to be more generous from that regard.
Very possibly, not always. It depends on whether you have the greater income or the greater capital within your partnership. So where you've got a couple where one has a very high income and one has a very low income, if we're talking a traditional couple where the man has gone to work for a long time, has got a high pension, woman has not worked so much, has got a smaller pension, very common situation. Whichever one is applying, one might have very high income, one might have a very low income. We end up with quite a different set of results from that. Okay. Which is why a lot of local authorities will go into and say, well, let's have a look at if you were to be treated as a couple, what would be fairer? Before we dig into how we're going to treat income and how we're going to treat capital, it's worth just thinking quickly about the difference between the two. What is income? What is capital? So first of all, income is a regular payment. So we would expect it to be paid on a regular basis. So every week, every month, whatever the period is. There doesn't have to be multiples of it. So if you get a job and you work in it for a week and then you lose your job, you only get one payment. There was an expectation at the start of that there's facility for that to have carried on. So we would say that is one payment of a potentially longer regular period. Also, it relates to a period. So if your wages, your salary is for the month or the week that you've worked, your benefits might be for the week or the fortnight or the 4-weekly period that you receive it. So when we're looking at what counts as income, we're saying there's a pattern of regularity, or at least there could be, and it relates to a particular period which can be identified. And then crucially, it's also not derived from capital. We don't want to count anything twice. We don't want to count something as both capital and income. So if at any point we say this is capital, any money derived from that is also going to be treated as capital, even if it's regular and maybe it relates to a period, like your interest on your bank account is regular, relates to the month or the year that you're being paid your interest for, but it's derived from a capital holding, which we're taking into account in a different way. So we would treat that as capital. So your capital then is any sums of money, shares, property. We're going to go through a whole load of different things that are going to count as capital, and the derived amounts from that. So your interest, your dividends from your shareholdings, things like that will be treated as capital, not income. Crucially, your personal possessions will not be treated as capital. We'll look at a few examples of that later on. So income, right? When we're looking at what income you've got, there are potentially dozens, hundreds of different types of income. The regulations don't itemize them all. They don't go through each one and say this counts and this counts and this counts and this doesn't count. What they do is they say they call out things that don't count, and then they will assume that everything else does. So we've got some kind of general rules which we can apply, even if we don't have a list of count this, don't count this. If we understand the general rules, we can be clear as to what might happen. If someone says, I've got this income, we can fit it into our general rule and we can be fairly sure how it's going to work. Maybe we want to look into the regulations to check, but we can be fairly sure pretty quickly. I count there as being 4 different types of income for a financial assessment. So first of all, we've got income from earnings and special disregards. These are things which the government kind of wants to encourage. They want to say, this is something that you will need. We want to encourage you to get a job. You fought in a war and you've become disabled. We're going to disregard your income from that. There are people that government wants to support or behaviours they want to encourage. We're going to disregard or partially disregard incomes that fit those special, government sanctioned activity, things that they want you to do. Then there's income for care related purposes. So any money that you get which is designed to pay for your care, we are almost always going to count. We're going to count that in our assessment. But if you've got income which is set aside for a different purpose, so you're being paid it probably by the government, maybe from other sources, but it's for a specific thing, and we can identify what that is, then we're almost certainly going to allow you to keep that money. So if it's specifically set aside for care, we're going to include it in our assessment, expect you to spend it on your care. If it's specifically for something else, we're going to ignore it. And then finally, we've got income from any other source. So if it's not called out as this is disregarded for this particular reason, then we are going to assume it's included in our assessment. Let's have a look at some examples of that first. So what are we likely to be taking into account? So things like pensions, employment and support allowance, income support, carers allowance, benefits that you get paid which are for your general living costs. They're not for a particular thing. So your ESA, your pension credit, it's not for a particular thing. It's money for your general living costs. We're going to include it in our assessment. Pensions, whether a state pension or a private pension, it's not for a particular thing. It's just general money. We're going to include it in our assessment. Universal credit, I've thrown in there as a head scratcher. Universal credit is for various things. Some of it is general, some of it is for specific things like looking after your children or paying for your rent. And it's one that many local authorities are a little bit unsure of what to do with. But actually it's quite clear in the regulations that universal credit should be counted in an assessment. Count it in full, include the full amount, and then make sure that if the person has particular costs, like for their rent or for their children, that they keep enough of the universal credit to pay out for that. So when we look at expenses later, we're just going to include expenses for your children, for your housing costs, and we're going to include all of your universal credit as income. So actually relatively straightforward. As I said, if it's not something that's been identified as being disregarded, we're going to include it. We can also include money which you don't have coming in, which you could have. That might be income which you have, you've identified, but you've just not gone acquired yet, or it might be income which we think you could claim. So maybe a benefit that we think you should be claiming this, you're not, we would normally advise you what you could claim, encourage you to go and claim it, and then give you an opportunity to do that. If you don't do it, we'll then include it in your assessment as if you were getting it. The most common most common income of that kind is pension credit. So huge numbers of people are entitled to pension credit and not claiming it. Vast numbers of people. And sometimes it's a very small amount, but it could be quite a large sum of money. So most financial assessment teams will check someone's income, whether they're entitled to pension credit, advise them to claim it, maybe help them claim it. But if they choose not to, we're going to assume they get it anyway. And that's standard and very common practice. Essentially, by not claiming pension credit, the local authority is having to pay more for their care, where the government could be paying it through their benefits. The government pays them the benefits and then they pay it onto the local authority. It's coming out of the right pot. Otherwise, it's being paid for by the council, and they probably don't have very much money. Right, so this is what I call special disregards. So there's a few things that come within this. I'm not including all of them here, but this gives you a feeling for how it should work. So things that the government wants to encourage or protect. So all earned income, that's whether it's from self-employment or from employment. Special annuities, so it's fairly unusual, but if you're being paid an annuity because you were awarded the Victoria Cross, you get paid a gallantry award for that, or you're getting an annuity through a personal injury payment. You've had a personal injury payout, and you have used that to buy an annuity, a pension. Then it's going to be disregarded. They're called special annuities, and we'll ignore them. A war disablement pension. So you've got an injury because of your service in the armed forces. We are going to disregard that war disablement pension in full. And that differs from regular war pensions, which are only disregarded in part. So again, the government wants to support war pensioners, but they're not going to give every war pensioner a full disregard of all of their income. So they're going to disregard part of it. Same with savings credit. People, if you're not sure, savings credit is a soon-to-be defunct benefit. It's being phased out at the moment, but it's designed to encourage people to make preparations for their retirement, to have some income to cover themselves when they retire, but they don't have loads. So savings credit can give them a little bit of extra money. That is partially disregarded in our financial assessment. This is another area where local authorities have some discretion. Well, local authorities have discretion in a lot of it to make things more generous. This is where they often put it into practice. So quite a few local authorities disregard all war pensions. Quite a few local authorities disregard all savings credit. That might be for ease of administration, or it might be because local councillors want to show their support for war pensioners, for example. So that you will see some disparity in different areas. Income for care-related purposes. If you're used to benefits and how the housing benefit system works, then I know that I found this one of the most surprising things, but when you think about it, it makes total sense. If you're being paid a benefit which is designed to pay for your care, so attendance allowance, the daily living component of personal independence payment, or the care component of disability living allowance, any of those benefits are going to be counted in our assessment. So whatever you get paid, that will be included in our assessment. Again, there's a little bit of leeway here. So some local authorities, well, I'm going to say many local authorities, disregard some of it, especially if the person is getting overnight care, which the local authority isn't paying for, then they're going to allow them to keep some of this benefit in order to pay for that overnight care, but they don't have to. And the regulation says these benefits should be counted in the assessment. And so some, like I'd say probably a majority of local authorities use local discretion to disregard some of this, but they are not required to, and plenty don't. And then finally, we've got income for particular other things. So if you're being paid money, particularly benefits, and it's designed to pay out for a particular cost, so housing benefit, is probably the primary example of that. You're being paid housing benefit, it is to pay your rent. Council tax support, you're receiving that is to pay your council tax. In fact, it's probably just a discount on your council tax, but if you happen to be paid a sum, it would be disregarded. Child benefit, child tax credit, those payments are also designed to meet the costs for your children. What else we got? Mobility payments, yeah. So if you're being paid PIP or DLA for mobility, then those payments are going to be disregarded. If we take them into account, you can't pay for these things. You can't get around. You can't support your children. You can't pay your rent. So we're going to disregard them, allow you to keep the full amount, and allow you to pay for those things that we know you need to pay for. Okay. And then just to wrap this section up, and then maybe we'll have a look at any questions that might have come up so far. What we're going to do is we're going to total all of your income. So if you are, in this example, we've got someone with a state pension. They're also being paid the high rate of attendance allowance. They're getting a private pension. We're adding all these sums up weekly. They get some housing benefit, and they have a part-time job. Possibly somebody on the higher rate of attendance allowance, it's maybe unlikely that they have part-time earnings, but you get the idea that we've got some income coming in and some of it is going to be ignored. So the housing benefit, ignored because you've got to pay your rent, and the earned income, ignored because we want to encourage people to work. So this person, we're going to add up the rest of their income, the state pension, the private pension, the attendance allowance, and we'll have a total income of £289.80p. Okay, right, we'll look later on at how that will be affected, how that will interact with their expenditure. Have we got any questions that we think are useful to look at now?
You have three I've noted. The value of the existing home, is that taken into account?
The what? The value of
where they live at the moment, if they own their own house.
Oh, right. No, we're going to cover that on almost the next slide, actually. No, the value of the house that you're in, ignored.
If somebody has savings for a funeral, do you take that into account?
Again, we'll talk about that when we talk about capital. And that is, well, we'll use that as a good example, actually, because that's something which local authorities have a big arguments over whether you should or not. I'll give you my view. We'll explain why.
And there was a couple of questions about, is there any passporting associated with this particular assessment?
So no, there's not. But there's something similar, which is called a light touch assessment. So everyone who wants to be assessed to see whether they should have to pay for their care will be assessed. So even if they've clearly got loads of money, if they want to be assessed, then they can ask for that, and the local authority should do it. What the local authority is trying to do is trying to get through as many as they possibly can. So if they can identify that there's an easy way of deciding that this person doesn't qualify for any help or qualifies for the greatest possible assistance, they'll try and do that in the simplest way. So if your income is just clearly too high, if you say, well, I've got loads of pensions and I've got loads of savings, then they'll just say, you don't qualify. We've done an assessment, you don't qualify. It's harder to identify if someone will definitely qualify for the maximum amount, but it is possible in some circumstances. So if they can, they'll look at pension credit and they'll look at things like ESA, income-related ESA, and they'll be able to tell quite quickly whether that person qualifies or not. They'll do a tiny assessment. They'll check, have you got any of the private pensions? Do you get attendance allowance? If so, how much? And if they can see from that very quickly, they won't go through and do the rest of the assessment that I'm about to look at. But there's no immediate, you get pension credit or you get income-based job seekers allowance, so you definitely qualify. Because the way that attendance allowance and PIP are taken into account, you can't be certain, but you often can be almost. So it takes a small check and then you're on your way.
I guess similar with the current DFG means test, it applies unless you get certain means tested benefits. So I guess if this was applied to DFG, you could potentially have a similar approach where if somebody's, say, on pension credit guarantee, then they were kind of passported through as assuming they wouldn't need to contribute.
Yeah, if you wanted to make it simpler, then anyone on pension credit, guarantee credit, or ESA, income related, they might be asked to contribute a bit towards their care, but it's not going to be very much. Even if they're asked to contribute a bit, it will be a small amount. So it could well be worth just saying, anyone on pension credit, anyone on ESA, you're gonna qualify for almost full assistance. We'll give it to you.
Okay, great. I think the next other questions you've got covered on the upcoming slides. So
great stuff. Great stuff. It's disconcerting seeing 72 comments. You think, oh, is there 72 different questions that someone wants me to answer? But we'll try and cover them all as we go. Right. What else have we got to talk about? So capital. Now, in a financial assessment, capital is often a bigger deal than it is in benefits. There are far more people who are in need of social care, who maybe have not been on benefits in the past, or are older and have got some savings, they've got some money aside. So there are far more people with capital and than on housing benefit, for example. Housing benefit calculations, yes, some people have money in the bank, but I think last time I looked, the average amount of savings someone on means tested benefits has is £40, I think. So it's quite an easy assessment. Whereas with social care, loads of people have savings, and so it's a big deal. Also, lots of people with savings who are receiving social care may be trying to get rid of it. A few different reasons for doing that. One might be you're older, you want to give some of your money away to your children, your grandchildren, and if you're now receiving a lot of care at home, or you're going into a care home, you might be thinking, I'll just get rid of it now. Also, lots of people who are receiving social care will have seen a financial advisor, and the financial advisor may well say, well, if your capital is over this limit, you won't qualify, so let's get rid of it. And there are perfectly valid reasons for doing that, but local authorities are going to be examining your capital in a lot more detail in this assessment than they would do for benefits. Our assumption with capital is that it's all going to be included. So anything which might be capital, might be savings, that is going to be taken into account. That's our default assumption. But there are loads of things that are accepted from that. So loads of disregards and loads of special exceptions, and treat this that way and treat that the other way. Quite a few of those count more for residential care, so maybe less likely to be relevant here. But there are still quite a lot of disregards we need to know about. And again, we've got to remember that it's the capital held by you, and if it's jointly held with a partner, it's your share of that. And we're talking things like property, that can often be quite a large sum. So it's worth remembering that. It's a thing that often gets missed. So if people are giving advice and you're not too sure what the rules are, a lot of people have been advised, oh, your capital is over the limit, you're not going to qualify, but it's actually the capital of just the individual. So it's always worth reminding people who are meeting the public, this is what the rule is. The maximum capital then is £23,250. If you have more than that, then you're ineligible for local authority assistance. So that's quite a bit over the capital threshold for benefits. So housing benefit, universal credit, employment support allowance all have a maximum capital of 16,000. Our assessment here is substantially over that, and that is reflecting that fact that a lot of people are older and have more opportunity for having acquired capital over their lifetime. And there also might be costs to come. We'll talk about funeral grants in a minute, or funeral payments. If you have capital below 14,250, so that's almost at the maximum limit for benefits. If you have capital at that level or below, then your assessment, it doesn't affect your assessment. You'll be able to keep all of that. none of that is taken into account when we work out what your capital is, or what we expect you to do with that capital. If you have capital between those figures, so more than 14,250 up to 23,250, then we're going to expect you to contribute some of that towards your care. So we'll work out whatever it is, we'll take away 14,250, and whatever the sum is left over, we'll divide that by 250, and we'll expect you to pay £1 towards your care for every £250 or part of £250 that you have. That's the same tariff income assessment, we call it, as you do in housing benefit and as you do in universal credit. The only difference is that this is identical for working age and pension age people. So there's no difference for housing benefit, for pension credit. If you're a pensioner, then we only assume £1 for every £500 you have. But for a financial assessment, we're doing it the same way for everybody, £1 for every 250. And there's quite a lot of leeway here. So you could have a lot of income being taken from this tariff. If you've got £22,000, that's a lot of tariff income. It makes a difference. Again, in housing benefit, hardly anyone has enough money to make any difference. But here, it can really affect things. What are we going to disregard then? So, as I said, there's a long list in my booklet that I use for my my assessments, for my training courses. I think we've got a bullet pointed list that goes on for 3 pages of all these things have to be disregarded. There's a lot of stuff, but most of it is very circumstantial and unusual types of things that you're not going to come across. So we might have to hit the regulations at some point just to make sure we're doing the right thing. But we can identify a few common things which are always or usually going to be disregarded. So first of all, the client's home. So a home that you live in, well, that's the definition of a home, place that you live in, that's going to be disregarded. So whatever the value of the property you live in, that's ignored. Any second properties, land, they're going to be taken into account, but the property you live in, even if it's worth a huge amount of money, that is going to be disregarded.
One of the strange things about the DFG test is, Dan, that if you have a second home and it's for sale, then you don't take it into account. Is that the same with this one? Or?
Right. So it depends on quite a few things. There are ways in which a second property can be disregarded, but it's unusual for it to be indefinite. So if you've got a property, is that true? If you've got a second property and you're selling it, no, that's not disregarded. That's going to be counted. Yeah, it's if it's your former home and it's up for sale. So if you move out of it into another place, then while that's up for sale, we'll disregard it. It's more likely if you move into a care home. So you move into your care home, we'll count the home that you were in. We'll disregard that while you're selling it. But if it's just a second property is up for sale, no, we'll count that in our assessment. I'll throw out another thought here. This is something which was potentially very controversial, in that it was one of the main points of the 2017 general election, where everyone remembers Theresa May's various promises on the care assessment, which were shot down by almost everybody, the dementia tax. One of the proposals was that your home would be taken into account. That was got rid of very quickly as an idea, but it was officially Conservative Party policy for quite a long time after that general election. It's not anymore, but it's the kind of thing which has been posited as potential changes. Yeah, and then you could get a loan based on that property to pay for your care if you needed to. There's a few other things like that where there's been suggestions of we could tinker with the system and change it a little bit one way or another. This is one of the areas, because obviously your home is one of your most valuable assets if you own your property. What other things are we going to disregard? Well, compensation payments. Most of those are most personal injury payments. So if you're paid, if you have a personal injury, you have an injury and you get a personal injury payout from a court because of that, then you will, if you put it in the right place, it's going to be disregarded. It's quite easy to have it disregarded in full indefinitely. Most people should be able to do that if they're advised in the right way. So if you put it in a trust, if you keep it with the court and the court administers it, if you use it to buy yourself an annuity, so a pension for the rest of your life, any of those things, it will be disregarded. Even if you just say to the court, I'll just have the money, please, I'll put it in my bank, we'll still disregard it for a year. So we give you the option of using it for certain purposes, whatever you need to do with it, maybe an adaptation to your property, use that money to pay for those things. As long as you spent it within a year, you're good. If you've still got it after a year, we'll take it into account. So you see, it's most personal injury payments. That idea of disregarding things for a fixed period of time covers a few other things as well. So if you have you make a claim for benefits and it takes a long time for it to come through, then the arrears of those benefits will be disregarded for a year. If you are what else am I thinking? There are certain assets of a business. That's another example of things that are disregarded. But if you stop your business can't carry on because of your condition. As long as you're planning on going back to work, so maybe it's a short-term condition, we'll disregard it for 6 months while you get ready to go back to work. So some of these things are going to be time-limited disregards. Many of them are going to be indefinite. Compensation payments. So we're talking there things like government compensation for if you were caught up in events. So people who were paid compensation because they were involved. They were caught up in the Manchester bombing a couple of years ago. Was it 3 years ago? There's a compensation fund for that, for people who were affected by the bombings. The Ariana Grande concert. Those compensation funds are disregarded. People who were affected by thalidomide, their compensation payments that have just been awarded for that, they're disregarded. So this is an itemized list, a very clear list of all these things are going to be ignored. If it's on the list, then we ignore it. If it's not on the list, we take it into account. What else? Chattels. Okay, so personal possessions, things which might be worth quite a lot of money, we're not going to take into account. Again, this is true in benefits as well, so it's not a revolutionary idea, but more people in social care are affected by this. They're more likely to have valuable things. Certainly my personal experience anyway is that this comes up far more often. It's relatively straightforward with things like you've got a gold watch, or you've got jewelry, or an antique. Those things we're not going to count. But anything else which could class as a possession or a chattel is going to be ignored. So that includes vehicles, it includes caravans, including static caravans. Almost always are going to be disregarded because they count as an item, not as a capital, a form of capital. Well, they are capital, but they're a chattel, so they're going to be ignored. Finally, do want to note the effect of life assurance policies. So if you've got a policy and it's going to pay out, it's worth a lot of money, could be worth a very large sum. Your life assurance policy is going to be ignored. It's relatively straightforward because you're not going to get it until you die, or your family aren't going to get it, your spouse isn't going to get it until you die. What is increasingly common practice is for people to take capital and to put it in a form with a life assurance policy attached. So if you've got a lot of money, maybe you've got a property, you sell the property and you buy you might put it in an income bond. So an income bond, you put all your money in there and then it pays you out an income for a fixed period of time. could also be called an investment bond. That would be included as capital. Whatever you put in there is included. And many people have got hundreds of thousands of pounds in investment bonds. They're not going to qualify for any help from us. But lots of people will get an investment bond and say, well, I want to attach life assurance to that. As soon as they do that, it's disregarded. This is also true in benefits, also true in housing benefit, also true in pension credit, but it's much less common. But it is something which affects quite a lot of people. And if you go around any financial assessment team in the country and you say, what about investment bonds with life assurance? They will throw things at you and tell you to leave the room, because it's a way of getting all your savings out of their hands. Maybe that's advice for a different client group. If you're going to be asked to pay your social care, stick it in an investment bond with life assurance. Right, we'll move on. I don't think I've got any other tips for keeping your money out of people's hands. Not that I'm going to share on this session. What are we going to take into account? Everything else. So everything that's not specifically disregarded will include lots of different things. Here's a few examples. So money in accounts, bank accounts, building society, post office, ISA accounts. So even if it's money that you can't currently get hold of, it's been put away, you're not expecting to take it out anytime soon, we'll include it in your assessment, because you could get it. Maybe you've locked it away for 5 years, you could still get hold of it, so we'll include it. Stocks and shares, unit trusts, you've got money put there, and many people do. We're going to include that in our assessment. Stocks and shares and property as well. There's very often a cost of sale. You can't realise the whole sum in one go. You would have to pay a broker or somebody or an estate agent to get hold of the money. So we'll take a nominal fee off those things, but the rest of the value we'll take into account after that nominal fee. Cash is something which so many people who receive social care have potentially very large sums of, under the bed, in the wardrobe, tens of thousands of pounds potentially. So that question is always asked. It's not always answered, but we always want to check to see if the person has got cash for safeguarding reasons as much as anything. You shouldn't have huge amounts of cash in the house. It's not necessarily safe. Property other than the home you live in, premium bonds, investment bonds, which we just talked about, trust funds. There's nothing inherent in a trust fund, which means we won't take it into account. So a trust fund is a form of capital, but very often a trust fund has been set up so that you don't have access to it. So if you have got your money and you put it in a trust fund and you say, I'm going to give control of it to my children, and then they can give me the money as and when I need it. Well, it's not your money anymore. You've given it to your children. So in that case, we wouldn't count it in our assessment. If you've put it in a fund and you're saying, I'm going to keep control of it, but I'm going to give it to my children, I can no longer give it to myself. Well, it's not your money anymore. You've given it to your children. So in either of those circumstances, your money isn't in a trust fund, not in one that you can access. So we won't count it. What we might consider in that circumstance, though, is whether or not you have deprived yourself of capital. And deprivation of capital, trust funds, but also other things, maybe this investment bond, is another way of, is another thing which is very common for financial assessment teams to be looking into. What have you done with your money? You used to have it, where has it gone? If that's the case, we're gonna include in your assessment notional capital. So it might be a trust fund, but it might be other circumstances too. You might just have given it away, not put it in a trust, just given it straight to your children. If that's the case, we're gonna analyse what's happened. There are two different types of notional capital. The most common type is this deprivation, but just like with notional income, if there's capital which you could get hold of but you haven't done, we can also treat that as notional capital. So maybe you've been left an inheritance but you haven't yet gone to the solicitor to actually get it. It's available to you, but you haven't sought access to it, we'll still treat it as your capital. Well, we have the option to still treat it as your capital, even though you don't have it yet. Much more commonly is this issue of deprivation, and where we think somebody has given away their money, either, as we say, they've given it as gifts to children, grandchildren, they've put it in a trust fund, which they can no longer access, or maybe they've spent it on something which is not appropriate. We're going to look at, we're going to ask them some questions, and we're going to try and see if it's a reasonable thing to do. So our first question is, was that action reasonable? Was there an intention to benefit from the system? And does it follow a previous pattern? Is it something you've always done? Even if it is something you've always done, we might still say it's unreasonable. But if we think that what you've done is unreasonable, you did intend to benefit from the system, and we can't see a pattern of behaviour which we're happy for you to continue with, then we will treat you as still having the money even though you've given it away. So you put £50,000 in a trust fund, we don't think you needed to do that, we can still treat you as having that £50,000. You've given away loads of money to your grandchildren, we don't think you needed to do that, we think you've given away more than is reasonable. So if you've given them gifts, that's fine. But if you're giving them very large gifts, and very large gifts that are greater than you previously did, then we're going to treat you as still having that. If you always give your grandchildren £200 every Christmas and you carry on doing that, that's fine. Follows a previous pattern. If you always give them £200 at Christmas and now you're giving them all £1,000 at Christmas, that doesn't follow the pattern. That's unreasonable. We'll treat you as still having that money. Very common. Financial assessors spend a lot of time over this stuff because loads of people are doing it. They're spending their money in different ways, and we're trying to work out, is it okay? I remember in that right at the start of the session we talked about what's the phrase? We want to promote well-being. Well, this comes into that. If you are giving away your money or you're spending it on something which is going to be to the benefit of your well-being, might not seem reasonable to you or I, but if a social worker says it's going to improve their well-being, or if they can give a good reason why it's going to improve their well-being, then we might agree to it anyway, even if it seems like a ludicrous extra expense. But if it really is important to that person, we may well allow it. Benefits are very unlikely to do that. DWP are very unlikely to do that. But social care assessment team, much more aware of the impact on the person's well-being. Right, okay, so we've looked at everyone's income, we've looked at their capital, now we need to examine their expenditure. How much of all that money do they need to keep? Before we dig into that, have we got some more questions, or do we need to take a short break?
I think we're okay. There's a couple, let's have a look. Something about if you're kind of releasing equity.
Yeah,
you kind of have an equity release mortgage, I think the question is about.
Yeah.
How would you treat any income from that?
Yeah, if you've got an equity release mortgage, then we would treat it depends what you're doing with it. Depends whether you're getting it as an income or you're releasing it as capital. If you're releasing it as capital, so you're getting a lump sum, we're going to treat that as money which you now have. Your debts we're not interested in. So if you now have a greater debt and a debt equal to or probably greater than the amount that you've released, we're going to ignore the debt. We're going to include the cash you now have in the bank. If you're getting it as an income, so there's a particular type of annuity you can get, pension you can get through an equity release scheme. If you're doing that, then again, we'll ignore the debt, whatever income you have got from it, the pension you're getting from it, the regular payments will include, but we can disregard the costs of it. So if you're going to be paying loads of extra money to your equity release people for interest and premiums and that kind of thing, we can disregard those costs if you're getting an income from it.
Okay.
It's quite specific.
If quite a few people when they're looking for adaptations might take a kind of crowdfunding or just giving campaigns.
Mm-hmm.
would that money be taken into account, or is there a way of not taking it into account?
Yeah, so if it's income, it would be ignored. Gifted income is ignored. But if it's lump sums, which is likely to be in this instance, then that would be included in the assessment. You know, if it's a gift you're receiving, we'll include it. We won't include it as income if it's a regular ongoing thing, but you're suddenly given £20,000. Doesn't matter where it's from. If you get it this way, we'll include it.
Okay.
You can make an argument. I need it for this particular thing,
yeah.
And then they might agree. The local authority's got the scope to say you need it for this thing, which you're saving for. We'll disregard it, but I wouldn't bet on it.
Okay, so it would be better to agree that with the local authority before you started the campaign, rather than leaving it till the end and having a nasty surprise, I guess.
Yeah, but you're only likely to have tariff income on it. So depending on what the sum is, it
right.
might only be a small amount that they expect you to use towards your living costs. Okay. So it wouldn't necessarily be. But if it took you over the limit and you now had too much money to qualify, that's not such a good place to be.
Okay, and there was quite a few conversations about beach huts and caravans. I don't know if you want to go into beach huts and caravans.
Right, there always is. I don't know why this is such a big deal, but I tell you, I've had more conversations about caravans than I've had about anything else. So without seeing what the conversations are, so caravans. So many people think that a caravan, especially a static caravan, is a property, and the rent on it can be classed as a housing cost. The ground rent can be classed as a housing cost, but the actual caravan itself is an item, is an object, it's a chattel. So must be ignored, unless there's one condition, unless it is so intrinsically linked to the land that it becomes part of the land. So if it's been bricked in and it's plumbed in and you cannot remove it without substantial building works, just like a house, you can't move a house. If you can't just pick it up and move it, then if that's the case, if you've done all of that and it's intrinsically linked to the land, it counts as land, it counts as part of the value of the land. But if there's any way that you could move it, when I was long time ago, when I was a freelance benefits assessor, which believe me is a weird life, I lived in a static caravan in Norfolk, and they're enormous, but I've seen them on trucks. People come in, huge lorries, pick them up, take them away again. So even a massive static van can be moved. If it can't be moved, it counts as capital, counts as the land. But that is very unusual, but not unheard of.
Okay. I think that's most of the questions.
Yes. Beach huts, I believe the same applies. Okay. If it improves the value of the land is what we would take. The same with the property. It improves the value of the land. Something parked on land can just be taken away. Doesn't improve the value of the land.
Okay.
If you want to see more, read the guidance in capital gains tax on HMRC. There's a challenge for you. If you want a fun weekend, go and read what capital gains tax has to say about caravans. Okay, right. Moving on. So expenditure. We've looked at what money you've got. We now need to examine what of it you're going to be allowed to keep. So we're going to divide this into 3 different sections: personal expenditure, disability-related expenditure, and housing costs. And they're all treated very differently. Personal expenditure is something which everybody is going to have. So everybody will be assumed to have some personal costs. This is, just before I talk about what it's like in care in your own home, we'll just note that if you're in a care home, we also do this. We look at what your personal expenditure is, but we're going to set you a very, very low amount. Momentarily forgotten what it is, £24.95 a week. You get that to live on. That is it. That's expected to cover all of your costs. There's some scope for variation, but you get this small allowance each week because all your other costs are covered. Your food should all be covered. You shouldn't have any bills other than the cost of the care home. So you just need that small amount for spending on other things. Many people find that nowhere near enough, £24.95 a week. But is that right? I think that's the right amount. But it's all the rules allow for. Some local authorities will bump it up, but most don't. If you're receiving care in your own home, then we're going to do a much more complicated calculation to work out what we think you need. And this is going to be similar to a benefit applicable amount, but not identical. So it's based on income support and pension credit. So if you're working age, it's based on income support. If you're pension age, it's based on rates for pension credit. When it was set in 2016, it was at the rates at the time plus a 25% top up. People often call it a buffer, 25% buffer on the standard rates. That hasn't changed since then, though. So I know this is an issue in DFG as well, that the rates haven't changed for a very long time. Well, these rates haven't changed for a few years. There is scope for the Department for Health, who set these rules, to increase them, but they haven't done. Many local authorities do, though. So they increase them each year. We know what the rates would be if they had been increased each year, and it's not so long ago that it doesn't bear that close resemblance to what it is now. And because of that 25% buffer, they're still more generous than the pension credit rates or the income support rates that they're based on. So you're still better off under this system. But as years go by, it's not quite as generous as it originally was. There are
New ones haven't been updated since 2008.
Yeah, that's definitely worse. My pet theory is that the Department for Health just keep forgetting to do it, but I could be wrong. Right, okay, but yeah, some councils do it themselves. I'd say that's a minority, though. Most councils have left it at the rate set by the Department for Health. What this is designed for is to pay for your basic living costs, your food, your bills, your clothing, travel, other personal expenses. So your newspaper, your booze and fags, all that kind of stuff. Anything which is not, there's not a benefit specifically for general income, we're going to expect you to pay for it from this personal allowance. And how's it worked out? There are different elements. We're going to add them together to come up with a sum. I'm not going to give you all the figures. If you want to know them, then I'll give you my email address. I'm happy to send them to you, or Google them. They're all out there. That you're going to have a standard allowance, something that everybody gets. That's the expected costs for those things of the average person of your age, and if you're a member of a couple or not, different rates depending on whether you are that. Is the standard amount that someone in your circumstances would need. We're going to add things on top of that if you've got more complicated circumstances. So if you've got children, there's an extra bit on top. If you're disabled, then there's a disability premium. If you're more severely disabled, there's an enhanced disability premium that can be added on. Neither of those things are added on for pensioners, because all pensioners are assumed to have those already factored in. Their standard allowance includes amounts for disability, because as you get older, you're not necessarily more likely to be disabled. Well, you are more likely to be disabled. You're not necessarily likely to be, but you're likely to have greater costs. You're likely to be at home more often. You're likely to have the heating on more. So your costs are likely to go up as you get older. So pensioners get those as standard. And then if you're a carer, if you receive or you are treated as if you could receive carer's allowance, then you get the carer premium as well. Different amounts for each thing. Add them all together, and you get a total sum. Like I said, very similar to that applicable amount for benefits, but just with that extra bit added on top.
Yeah, it's very, very similar to the DFG means test, I think.
Yeah. One thing it's worth pointing out is not included here is a severe disability premium. So one of the more complicated bits of the basic benefits calculation is the severe disability premium, and it's quite a large sum of money. It's not included in here. We're not giving you an allowance for it because we are expecting you to use your severe disability premium to pay for your care. That's what it's for. severe disability premium is, what is it, £69 a week, around about that, 68, 69, something like that. It's designed to pay for your care if no one is paying for it. No one is receiving money to provide it for you. So many people get that. That is not included in this care assessment. It could easily be added back in though. If it was thought that that is going to make a difference, that's going to be of detriment to people receiving this test, you can include it as well. We know what all these figures are. Severe disability premium is easily extrapolated from that. Just to emphasize the issues for a couple, if you're a single person, there's a standard rate. If you're a couple, then if you're receiving benefits, it's usually around about 1.5 times what a single person would get. You're assumed to live more cheaply if you're a couple. But remember, we're doing an assessment on you as an individual. So the amount for half a member of a couple is lower than the rate for a single person. And this is where some councils think that's not fair. So they do a test on half the allowance for a couple. They also do a test on the standard allowance for a single person. But that's not part of the regulations and is not required, and lots of councils don't. But many do that to try and add in a bit of fairness. I'm not convinced it is fair, but it's there as an option. Right, so everyone's gets an allowance for their basic living costs. We then need to look at what you actually spend. So disability related expenditure, you will hear the term DRE, is looking at your particular disability related costs, and then your housing costs again is specific housing costs. So your DRE, disability related expenditure, that's money that you spend on things that are related to your disability, maybe to your care, but maybe just for your disability, your care package isn't covering. So if you've got particular extra costs, then you need to keep enough money to pay for all those things. And there's a specific list. So the regulations set out all these things are going to be covered by disability related expenditure. If you have that cost and you receive a disability benefit, so if you receive attendance allowance or disability living allowance for care, personal independence payment for daily living, then you must be allowed to keep enough money to pay for those extra things. But it's got to be reasonable. It's got to be something which you need. So if you, there are different ways that councils will approach this, but if you say, I'm disabled, I've got this condition, I need this extra, I need to spend extra money on special dietary requirements or incontinence wear, then most councils will just say, yeah, that's fine. If it's something more complicated or less common, then you might need a social worker to say this person needs that support, needs to pay for this thing. I was working in Surrey recently, and a lot of people in Surrey have come across a lot of cases where the person has been is having horse riding lessons as part of their rehabilitation, and that is counted as DRE. So that person has a particular condition or particular illness, and the horse riding is helping with their rehabilitation. We can count the cost of that as DRE and allow them to keep the money to pay for it. So there's a lot of things that it could potentially cover. We've got some examples. Like I said, there's an itemized list, but one of the items on that list is something occasioned by the person's disability. So if you can make a case for it, almost anything could be in here. A community alarm system, privately arranged care. That might be respite care, or it might be that the local authority provides care for you in the day, but doesn't provide care overnight. So you might have to pay for someone to come in overnight. You need to retain enough money to pay for that. And then various specialist items, so things that are required by you because of your disability. So washing powder, additional clothing, bedding, dietary needs, garden maintenance, extra heating costs. There are lots of others. Those are some of the most common. You need to have enough money to pay for those things. How will we work out how much you need is different depending on the local authority. So the regulations don't prescribe how you do that. They just say, if you've got a disability related expense, you need to keep enough money to pay for it. So some councils take that as, okay, show us your receipts and we will allow you the money to pay for those things. So every time you pay for it, or show us your contract, bring that in, we'll tick it all off. We'll say, okay, sure, you can keep the money to pay for that. Other councils will say, right, you've got extra heating requirement, or you need to pay for extra incontinence pads that aren't included in your care package. There are standard costs for that. That costs this amount. That's the average cost. So we're going to include that in your assessment. So you don't have to provide receipts. You don't have to say exactly what it costs. You say, oh, I need this thing, that thing, this thing, and that thing. And the council has a list and they include whatever the standard amounts are for their list. Now, it might be a list that's provided by social services, or it might be one which is standards that many financial assessment officers across the country will use. This is what it's likely to cost. If the person then says, but I spend more than that, then the council has to allow the higher amount if they can prove it. So it's very common practice to just use these standardized amounts and then say, but tell us if it's more than that. Even more straightforward and simple way of doing it is saying anyone who receives a disability benefit is likely to have some extra costs. So we're going to assume a basic minimum amount, and we're going to give that allowance to everybody, no matter what they say. They don't even have to say, I've got this cost, that cost, and this cost, and we use the average. We're just going to say, and this is an example, if you receive lower rate attendance allowance, we'll assume your costs are £10 a week. If you receive higher rate attendance allowance, we'll assume they're £20 a week. And if your costs are more than that, come and tell us, show us the evidence, and we'll increase it to whatever it is that you need. But you're going to reduce admin hugely by just using these standardized sums.
That's what we suggested in the DFG review.
Yeah, and it's what I would suggest as well if I were doing it. But maybe that's just because I'm lazy. But it's very, very. If you're going through everything, all the receipts, it takes forever. So this really cuts down on your admin cost, and you might end up spending a little bit extra on DRE, but the amount of time you spend by not going through everything is a huge saving. I would say, just before we move on, I would say that councils are probably split kind of a third each in these different systems. Maybe the middle one is slightly the most common, but there's quite a lot of variation. I would definitely recommend the lowest one. Right, finally, a final item of expenditure is housing costs. So again, this differs, I think, for what we're doing already. This is where whatever you spend, we're going to give you allowance for it. We don't want to say you're living somewhere too expensive, you can't afford to stay there and also receive care from us. No, we've got to make sure that everyone gets the care that they need. So we're going to allow you whatever your costs are. So your rent, your ground rent, your mortgage, whatever you're paying, whatever the cost is to you. So if you're receiving a housing benefit, the cost to you is your rent less your housing benefit. So if your rent is £100 and you receive £50 of housing benefit, we're going to say that your housing cost for rent is £50, the bit you have to pay. Your council tax, again, that's a necessary property cost, housing cost. Buildings insurance, not all local authorities do that. They do after I go and do the course with them. They go, oh, I didn't realise that. Property maintenance, as long as it's reasonable, and service charges. Service charges that are eligible for housing benefit. That is things which are included in the rent, which are intrinsic to living that property. That includes things like where there's a garage attached to the property which cannot be let separately to the property. It's not fair for us to say, well, you've got an extra garage, we're not going to cover that. You couldn't not have it, so we'll include a service charge for that. We'll allow you a cost. If you live in a shelter housing block, then the cost of lighting the communal areas, heating the communal areas, that's all eligible services. So we'll expect you to keep the money to pay for those things.
I think that's probably the biggest difference between the two tests. With DFG, it's assumed to be £61.30 a week, regardless of where you live, what you live in, and whether it's got a mortgage or not, or whether it's rented. Everyone's assumed to be £61.30 a week.
Yeah, whereas your rent is potentially hugely higher than that. Mortgage is potentially hugely higher than that. Council tax in some areas is getting on for that. So yeah, a massive difference, and all these extra bits added on top: buildings insurance, property maintenance. You know, it all adds up. All these extra bits you can account for.
Yeah, I think with DFG at the moment, if you can afford, if you earn enough to afford a mortgage, then you almost certainly earn too much to get a DFG.
So we've seen this slide before, but we saw it before we have gone through all the calculations. So we're just going to quickly recap on how this all fits together. So the first thing we're going to do is we're going to look at your capital. So we've looked at what's disregarded, what's not, how we take different things into account. We're going to total everything that's not disregarded, and if that is over the 23,250, we're not going to carry on with the assessment. We're going to say you don't qualify. We don't need to do anything else. That will count as a light touch assessment. Remember we said that. You don't qualify. Come back to us when your capital drops below that limit. And with some of the costs that people are paying for their care, that is potentially relatively quite quickly. If their capital is below the threshold, then we're going to add up all their income and tariff income from their capital. We're going to add up all their expenses, personal allowances, DRE, housing costs, and we're going to deduct the expenses from the income. So whatever your income is, minus your expenses, that's your excess income, and we will expect you to contribute that towards your care costs. Not tapered, just the full amount. We've got a little worked example here. So this person here has got £12,000 in the bank, £3,000 of premium bonds, £5,350 of shares. After we've done a calculation to figure out how much of their shares we should be taking into account, remember we allow them to keep some of it because they've got to pay their broker to actually get the money. We're going to total that up, and they've got 20,350. That's below the limit, so we can carry on. They have a state pension, they've got a private pension, they get higher rate attendance allowance, and that 20,350 works out at £25 of tariff income. So we're going to expect them to take £25 out of their bank or wherever out of their premium bonds, whatever they want to do, and pay that towards their care each week. So they've got a total of £318.35 of income. We're then going to take off their expenditure. So their minimum income guarantee, they're a pensioner, single pensioner, they're going to be given an allowance of £189. That's what we expect a pensioner, single pensioner to live on each week. They've got the high rate of attendance allowance. So if we're using our standard, we think £20 for a higher rate is reasonable. That's my example. That's not it was not in the report. That's what I'm coming up with. We're going to give them that, and then the housing costs £45. So that's probably council tax and maybe buildings insurance and some maintenance costs. If they had a mortgage, that could be quite a lot higher. If they were paying rent, that could be even higher. Their total costs are £254.17. So you just take one away from the other, and that person will be expected to pay towards their care £64.18 each week, as long as their circumstances remain the same. Okay.
So I looked at that figure using the DFG test at the moment calculates a weekly figure in a similar way, and then it has a calculation at the end which turns it into a loan, or the amount the person could take out a loan. So for an owner-occupier, that would be equivalent to a contribution of about £1,500, and for a tenant, it would be roughly equivalent to about £890. So that's roughly, for an owner, a loan over 2 years, and a tenant, a loan over 1 year.
Okay. So there's a few things that we've already brought out, but I just want to kind of wrap up with a few ideas, and then we'll have any last questions. So what do we need to know about this system? So it's universal. So every social care assessment team in England and Wales will use the same basic system. It's broadly the same in residential care and in home care. So that's, again, it's making it more familiar to more people. There are local variations. We've said couples, local authorities may disregard certain incomes and other ones don't, but they're all more generous. So any time where the local council is doing something more generously, or doing something different, it's all giving more money to the client. They can't make it harsher than the system. They're allowed to make it more generous. Not huge variations, but there's some. Most local authorities have got at least a couple of tiny things that are different. It's a recent system, so it's only just been designed in the last few years. It's going to be recognisable to a lot of people. Anyone who has a financial assessment for social care is going to come across this system. What are the kind of salient points? It treats disability payments as income, but disregards earnings. It looks at the income and needs of an individual rather than a couple. It looks at your actual housing and disability expenditure. So what you actually spend, gives a more generous personal allowance than benefits do. But then it assumes everything you've got left over is available for a contribution to care. So we're being quite generous compared to benefits. I'm not saying whether it's generous morally or not. It's more generous than benefits. It's giving you a better starting point. Everything you spend, we're going to give you a higher personal allowance. We're going to make sure you keep all of this, but then everything you've got left over, we're going to expect you to use that to pay for your care costs. That's about where we are. Right. Any further questions?
I think people are just trying to get their head around. So the idea of this was that it was something that was suggested within the DSG review. And when we've talked to people about it, I think it was difficult to understand what it would mean in practice. So hopefully everybody who's been here and had 300 odd people this afternoon now have a much better idea of how it works in practice. And I think in some ways it's fairly similar to the DFG assessment in terms of you assess similar things, but some of it you treat in different ways. And I think some of those ways are probably more appropriate actually, given that it's a grant for based on disability rather than somebody's housing as kind of housing benefit was. Somebody just did ask you to recap about the thing about funeral plans.
Oh yeah, sorry, yes. Right, yeah, okay. So a funeral plan, where that comes in is to do with notional capital. So if you've got you've got your savings, if you decide that you are going to buy a funeral plan now, pay for it so that your surviving relatives don't have to sort it all out after you've died, then the question that's always asked is whether or not funeral plans whether that's a reasonable use of your money. So remember we said about with notional capital, or the deprivation of capital, if you decide to spend your money on something which is unreasonable, then the local authority might treat you still having it. So if you buy a funeral plan, well, a funeral plan itself isn't capital. We can't say you've got £3,500 in a funeral plan. It's not like a bank account. So we wouldn't say you've got that money. What we might say though is you shouldn't have spent that now. You didn't need to spend that now. That money doesn't need to come out of your account until after you've died. And if you've got more than the lower threshold of capital, 14,250, if you've got more than that, you should be paying for your care now. And then when it drops below that, anything left over, that should be enough to cover the funeral. You can use that to pay for it. So there's a huge argument between local authorities whether that is a reasonable statement to make, or whether it's very sensible forward planning to pay for a funeral plan, and they will treat you as having spent that in a reasonable way. So almost every local authority that I go to, I have a big argument. I don't have an argument. They have a big argument, and I try and referee it as to whether it should be disregarded or not. you had £18,000, you spent £5,000 on a funeral plan. Do you have 13,000 or do you have 18,000? And to be honest, my view is that you have 18,000. You didn't have to spend that now. It may seem reasonable, but it doesn't have to. But I would say 50-50, depending on which local authority you're in, whether or not they'll treat you as having 18 or the 13. And I'm in the privileged position of not having to tell somebody that they shouldn't have paid for their funeral plan. I can just say it in the confines of my home, and no one is going to consider that I'm mean. Although you all might now do that. But I think probably it should be treated as a not a necessary expense.
Okay.
But you may disagree.
A couple of people just asking me to recap on how the weekly contribution or the weekly amount turns into the contribution for DFG. At the moment, with the DFG means test, you take the weekly amount and calculate how big a loan you could take out. So, for instance, given the £64 that was used in the example, you could take out, if you're an owner-occupier, it would be a loan over 2 years, which would mean you could take out a loan for £1,500, and that would be a contribution. And if you're a tenant, you would take out a loan over a year, which was just under £900 as a contribution. So that's how the calculation works at the moment. And you could take the output from this assessment to do the same thing with it, to turn it into a one-off contribution for DFG. A couple of people have asked about is how do people work out the sums in practice? Is there kind of a spreadsheet or a software or sheet of paper or?
So there are a couple of big software companies who mainly will provide social care software. So they provide tools for social workers to manage caseloads. But as part of that, or as an aside to that, they provide something to work this out. It's not all. There are some specialists that just do this. That software is, it's not that different to a spreadsheet, to be honest. It's add up your income, add up your expenditure, take one from the other, and most of the software requires you to type in what those things are. It will do some of the work for you, but the calculation it's not that hard. It's the figuring out what to include and not include that's the trickier bit. But that's the same for benefits. The figuring out, do I include this, do I not include this, is the bigger part of the job rather than the adding up. And with this assessment, as opposed to benefits, there's no percentages and there's no taking one thing away from another and then dividing it by this. It's just add up all that side, and take one from the other, and that's your output.
So I've been out with some financial assessment officers in the past, and I was surprised how quickly they did them. So we saw them really quickly.
Yeah. If you've got someone with a relatively straightforward situation, then a lot of financial assessment officers will just do it on a piece of paper, and you can do it in 5 minutes, 10 minutes.
Yeah, great. I think that's just on 90 minutes, and I think we've answered most of the questions there, Dan. So thank you so much for doing that for us.
It's a pleasure.
Do you want to share your contact details again?
Yes.
If anybody wants to get in touch?
Yeah. Please do. I'm very happy to answer any queries. Go to the website or email me directly. dan.rust@turquoisetraining.co.uk. Do write that down, because when I came up with the company Turquoise Training, I thought this sounds quite nice. No one can spell it, so do try and write that down. Otherwise, you won't get hold of me. Happy to answer questions on this, how it all works. Also, the company provides training. It used to be face-to-face training. I'm now currently figuring out putting it all online. We do training on benefits, on universal credit, on financial assessments, and we'll be looking to roll more of that out in the future. So drop me a line if you're interested in hearing any more. Happy to just chat with anyone about how it works. And if you do want any training, let me know.
Great, thank you, Dan. I think what we've learned is that any means test is relatively complicated when you first look at it, and actually after you've done perhaps a dozen, practice makes perfect, I guess, as with all things. So
That's right.
thank you very much, Dan. And for those that you haven't been free for all of it, or if you want to share it with your colleagues or friends, then we'll have a video up on the Foundation website and our YouTube channel later in the week. So thank you, Dan, and thanks for everybody for attending today. Thank you.